I had to kill Instagram. I wanted to stream to Instagram as well, but I had to kill that. So this live stream just ended. I joined 20 minutes too late to it, and by the time I had all the kinks ironed out of the streaming software and the problems with Instagram and multi-streaming, blah blah blah, it was over. So this is
joining us online.
Still fresh.
I'm Luis De Aro with the communications.
I'm doing live comments, but
at the IMF.
Technically,
and we
the
are
IMF
here today for the presentation
is now
of our
offline.
latest edition of the World Economic Outlook, titled "A Critical Juncture Amid Policy."
First things first. The
I
IMF.
hope
What is
that
it?
by
The
this time you all
IMF
have
is the
had access
International
to
Monetary
the
Fund.
document. If
And
not,
what that
I would
means
like to encourage
is
you, as
they
always, to
are,
go to imf.org.
as I've said before, the
You're gonna find the
Bank of
document.
Banks are central banks. You have your Barclays,
Also,
your
yes, a blog
commercial banks where you keep your money,
assets, including the
and
underlying data for some of
they are regulated, and their bankers are the central bank, the Bank of England for England, the Federal Reserve for the
I
US.
also want to plug in that we have
Then the
a
bank
new,
of the
database
bank's
portal
banks.
that I encourage you to use.
That's what the IMF is.
What's best that to discuss the new outlook that having here with us today, Pierre-Olivier Gourinchas. He's the economic counselor, the chief economist, and the director of the research department. Next to
And this
him
dude is
are Petia
their chief
Cueva-Brooks.
economist.
She's the deputy director of the research department. And last but not least, we also have Denise Egan. She's division chief also with the research department. Pierre-Olivier, as usual, is going to start with some opening remarks, and then we're going to open the floor to your questions. I just want to remind everyone that this
That's where it gets
briefing
good. I was
is
there for
on
that
the
part.
record, and that we also have simultaneous translation. So let me stop here. Pierre-Olivier, the floor is yours.
Thank you, Jose, and good morning, everyone. The landscape has
What's
changed since our last World Economic Outlook update in January. We're entering a new era as the global economic system that has operated for the last 80 years is being reset. Since late January, many tariff announcements have been made, culminating on April 2nd with near universal levies from the United States and counter-responses from some trading partners. The U.S. effective tariff rate has surged past
I can
levels
stop now as well.
more than 100 years ago.
This is effective tariff rate. Tariffs, as you know, are taxes on products and services, products coming into a country. Taxes on imports, blah, blah, blah. So this is showing.
While tariff rates on the U.S. have also increased. Beyond
this
the
is basically
increase
saying
in
the United
tariffs,
States since the
surge in policy
mid-1800s
is a major driver of the economic outlook.
was going up and down,
if sustained,
but with a downward
the
trend.
increase in trade tensions and uncertainty will levies from the United States.
I wonder if
and counter
this cyclical
from
nature of it,
partners.
the ups and downs,
The US
if you overlay
tariff
it
rate has
with
surged
the
past levels
economic
reached
cycle,
more than 100 years
growth
ago,
and
while
fall
tariff rates
of the
on the US have also
economy,
increased.
I might do that
Beyond the
actually.
abrupt
I will do
increase
that
in
for a lesson.
tariffs,
Maybe
the
put it online.
surge in policy uncertainty is a major driver of the economic outlook. If sustained,
The surge in what? The surge in
increase
policy
trade
what?
tensions reached more than 100 years ago, while tariff rates on the US have also increased. Beyond the abrupt increase in tariffs, the surge in policy uncertainty is a major driver of the economic outlook. If sustained, the increase in trade tensions and uncertainty will slow global growth significantly.
Guys got mutton
Reflecting
chops.
this complexity,
When I
our
do it,
report
people call me
presents
psycho, but
a
the guy in
reference
suit
forecast which
works for the IMF
incorporates
does it.
policy
It's-
announcements up to April 4 by the US and trading partners. Under these reference forecasts, global growth will reach 2.8% this year and 3% next year, a cumulative downgrade of about 0.8 percentage point relative to our January 2025 WEO update. Our report also offers a range of forecasts under different policy assumptions.
Global
Under an
economic
alternative
threshold,
path that excludes
downturn
the
threshold.
April tariff announcement.
That's just a line they draw
global
and
growth
says,
would
if
have
anything
seen
falls
only
below there,
a
we'll
modest
call it a
downgrade
downturn in
to
the economy.
3.2%
But that's a line they
this
just
year.
make up. They could put whatever they
We also
want. They could
use
put
a
on 5% if they want.
forecast to incorporate the temporary
And if they did, then
suspension
we'd
of
be in a
most
recession
tariffs
globally.
announced on April 9, together with the increase in bilateral tariffs between China and the US to prohibitive levels. This pause, even if extended permanently, delivers a similar growth outlook as our reference forecast, 2.8%, even if some highly tariffed countries could benefit. Now, while global growth remains well above recession levels, all regions are negatively impacted.
Well above recession levels, according to you, right?
And the global disinflation process continues, but at a slower pace, with inflation
where you
revised
decided
up
line is
by 0.1
acceptable.
percentage point in both years. These trade tensions will greatly impact global trade. We project that global trade growth will be more than cut in half, from 3.8% last year to 1.7% this year. The tariffs will play out differently in different countries. For the United States, the tariffs represent a supply shock.
That sounds like they've done some complicated maths behind it, but they really haven't. It's like, if on average the increase in tariffs, if the increase in tariffs, if your tax increases, if your tax bill doubles,
growth down by
your income halves,
0.9
right?
percentage point to
It's like
1.8%, with
grammar
a
school maths,
0.4 percentage
grammar
point
school
downgrade
logic
from the tariffs only, while inflation
on fancy
is
graphs
revised upwards. For trading partners, tariffs act mostly as a negative external demand shock, weakening activity and prices, even if some countries could benefit from trade diversion. This is why we have lowered our China growth forecast this year.
Some countries could benefit from trade diversion. That means that if a country decides to import its products from a different country because they're too expensive to buy from country A, let's buy from country B. Country B will benefit because now they have a country to export to, and that country might be the US, and that country B might be some tiny little country in Africa, not like a superpower like China. That goes without saying. That's not like that might happen. That's for sure going to happen. Well, maybe not, because they might. In the short run, that's definitely going to happen. Immediately, people still need their bananas, for example, right? So that's not going to change. Consumer habits don't change overnight, no matter how expensive things get. The suppliers, the people who are importing, the supermarket or the local market, will just find somewhere where they can buy it for cheaper from elsewhere in the world. That's going to happen well before consumer preferences change from bananas to apples, which are grown locally, or some business sparks up an innovative way to grow indoor bananas anywhere in the US in a solar-powered vertical farm.
To 4%, while inflation is revised
that could
down
take
by 0.8 percentage point, increasing deflationary pressures. All countries are negatively affected by the surge in trade policy uncertainty as businesses cut purchases and investment, while financial institutions reassess their borrowers' exposure.
That just means
Uncertainty
nobody knows what's
also
going to happen, and it
increases
sucks
because of
for
the complex
everybody.
Sectoral disruptions that tariffs could cause up.
No one
and
ever
down
really knows what's
supply
going to happen,
chains,
though. It's the
as we
illusion of
saw
certainty.
during the pandemic.
That's what they're puddling. That's what this is all about.
The tariffs could appreciate.
That's what all these graphs are for.
As in previous episodes. However, greater policy uncertainty, lower U.S. growth prospects, and an adjustment in the global demand for dollar assets are weighing down on the dollar. Risks to the global economy have increased
Thank bankers
and
for
are
that.
firmly to the downside. First, while we are not projecting a global downturn, the
You're
risks
making nice
that may
graphs.
happen this year have increased substantially, from 17% projected back in October to 30% now. An escalation of trade tensions would further depress growth. Financial conditions could also tighten as markets react negatively to diminished growth prospects and increased uncertainty. On the flip side, growth prospects could immediately improve if countries ease from their current trade policy stance and promote a new, clear, and stable trade environment. Addressing domestic imbalances can also
That means
help
get
raise
your
growth
together.
while contributing significantly to closing external imbalances.
If you're going to raise tariffs
For
against
Europe,
this country,
this means
find your
more
country
emphasis on
B
public infrastructure
and make
to
some
accelerate
deals.
productivity growth. For China, it means boosting support for domestic demand, while for the US, it means stepping up fiscal consolidation. Turning to policies, our recommendations
consolidation.
call for prudence and improved collaboration. Let me
That's a
outline,
kind of loaded
some
phrase.
key ones.
Fiscal policy
First,
is
an obvious
taxing
priority
to get
is
money
restore trade policy
into the government
stability.
and then
The global
expenditure,
economy needs a clear,
budgeting
stable, and
it
predictable
out and
trading
spend it.
environment, one that addresses some of the
Consolidating,
long-standing
so
gaps
I think
in
that's-
international trading rules.
He's probably looking
Monetary
at countries like the
policy will need
US,
to remain
sorry, the
agile
UK.
and respond by tightening
How much
where
are they spending on
inflation
public health care
pressures reemerge,
versus
while
welfare
easing
benefits
where weak
versus
demand
military?
dominates. Monetary policy credibility will be key, especially where inflation.
In other words, like he's saying, consolidate. Restructure, I think, is probably what he really wants to say. So, or like how you'd say consolidating your debts. If you have like several credit cards and then you get one big loan with a better interest rate to pay off those 3-4 credit cards so that it's easier to repay it. Imagine that on a government, that's what fiscal consolidation means, that on a government scale where they're restructuring where their money's coming in from, where this coming out from, in order to try and create more growth in the economy with their new partner, country B, substitutes for whoever is now blocked by a tariff to restructure their debt or their cash flow. So they're not bleeding money.
Expectations might de-anchor. And
Now,
central
from
bank
fiscal,
independence
he's gone to
that
monetary.
addresses
The other
some of the long-standing gaps in international
economic
trading
toolkit.
rules. Monetary policy will need to remain agile.
monetary policy, that's controlling interest rates and the amount of money. So basically, the amount of money in the economy and the cost of that money if you're borrowing, or the growth rate of that money if you're investing, interest rates.
Agile and respond by tightening where inflation pressures reemerge while easing where weak demand dominates. Monetary policy credibility.
Interest rates to control inflation. How that works is that interest rates that are the reward for saving and the cost of borrowing. So if they go up, then you're more incentivized. It's like government. It's like it's guys like this trying to say, hey, stop spending your money. Doesn't it make more sense to save? Because if you put it in a bank account with the interest rate that's going higher this year, then you're going to make more money from it sitting in the bank for one more year instead of spending it. And the flip side of that is if you don't have money to save, then you're probably on the other side of the fence that needs to borrow money. So if the interest rate's going higher, then it's telling you, whoa, maybe you shouldn't be borrowing money. Because if you can't borrow the money, then you're not going to spend the money. And spending is what creates inflation, because the more that we spend, the more businesses go, hey, I'm doing pretty good here. I can raise my prices a little bit. People are buying. And if you don't have money to save and you don't have credit to borrow, man, it's the government's problem. Let them figure it out with fiscal policy. Let them figure it out with their taxes and their expenditures and their consolidation.
Will be key, especially where inflation expectations might de-anchor.
Monetary policy is the central bank's
remains
toolkit.
a cornerstone. Many fiscal authorities will
Federal
face new
Reserve.
spending needs.
And they do not
bolster
work for the
defense
government, and the government does not
spending, or
work for
to
them.
offset the
They
trade
are separate
dislocations
things.
likely to come. Some of the poorest countries, also hit with reduced official aid, could experience that distress. Yet, debt levels are still elevated, and most countries still need to rebuild fiscal space, including by implementing structural reforms. Support, where needed, should remain narrowly targeted and temporary. It is easier to turn on the fiscal tap than to turn it off. Where new spending needs are permanent, as for defense spending in some countries, planning for offsetting cuts elsewhere or new revenues should be made. Finally, even if some of the grievances against our trading
What kind of
system
new
have
memories
merit,
could he be speaking?
we
New
should all work
revenues,
towards fixing
revenue
the system
streams.
so that it can deliver better opportunities to all. Thank you.
Thank you, Pierre-Olivier. Before we open the floor to your questions, some ground rules. First of all, if you want to ask a question, raise your hand. If I call on you, please identify yourself and the media you represent. Try
If you
be
want to
succinct
fight, you
and
got to
stick
throw
to
down
one
your gloves,
question.
take your
We
helmet
want to
off.
answer as many questions as possible. And also a reminder, we are here to discuss the World Economic Outlook. Those questions regarding country programs, institutional issues are going to be better placed for the regional press briefings that are happening later this week, and also the managing director's press
I'll be ready for those.
Thursday. With that said, I want hands up. Okay. So I'm gonna start here in the center. There, I'm gonna move the room to my left and to my right. I'm gonna start the lady with the green jacket there.
Lady in green.
Thank you. Hi, Andrea Shalal with Reuters. Thanks so much for doing this. Pierre-Olivier, I wonder if you can speak a little bit to the fact that you haven't called out a recession. And, we are hearing lots of economists in the United
because you drew the
States
line
and
at
other
2%.
places. Most recently, yesterday, the IMF
What do you want me to do?
is now
Draw it
also
at 3?
forecasting a small recession in the second half of the year. What we see in
Nudge, nudge, wink,
WEO
wink.
is that the percentage of risk of a recession has increased pretty dramatically. Can you walk us through why you are not at this point calling a recession, for instance, likely in the United States, and what it would take to tip it that way? Thanks.
What it would take to tip it that way is for him to say it's going to happen.
For the United States, we are
These mainstream media
a
people, I tell you.
slowdown. We're projecting growth will be at 1.8% in 2025, and that's a 0.9 percentage point slowdown revision in our projections from January. But 1.9%.
That's January. That's pre-Trump.
A recession. And the reason for
2.0.
this is that we have a U.S. economy that, in our view, is coming from a position of strength. We had an economy that was growing very rapidly. We have a labor market that is still very robust. We've seen some signs of
A labor market that's very
weakening and
robust. That
slowdown
means a
in the
lot of
US
people
economy, even
looking for
before
work that have
the
skills.
tariff announcements. So in fact, the
Hello.
0.9 percentage point downward revision that I just mentioned, only a part of this, maybe 0.4 percentage point, is coming from the tariffs. Some of that is also coming from weakening momentum. This was an economy that was doing very, very well, but was self-correcting and cooling off a bit on its own. And we were seeing already consumption numbers coming down. We're seeing consumer confidence coming down. So all of that was already factored in. But we're not
Consumer
seeing
confidence.
a recession
That
in our
means
reference forecast.
naturally
As you mentioned,
spending less
Andrea,
without
we
having
are,
to adjust
when we
things
do our
like
risk assessment, if you
income
want,
tax,
we are seeing the
VAT,
probability
or
of a
interest
recession
rates.
increasing from about
Naturally
25%
correcting
back in
itself
October
is things
to
like
around 40%
prices
when we assess it now.
and the cost of things naturally
Okay,
changing without
I'm
those
gonna move to this side.
economic
The lady
toolkits
here
to
in the red.
intervene just because people are naturally
Good morning.
buying
It's Noura
more
Marshi
or
from
less,
Ashfaq
and
Bloomberg.
businesses are
Pierre, I wanted to
raising or
ask you
lowering their
about the
prices
downward
because
pressure
of
on the
supply
dollar
and demand
now.
and nothing else.
To what extent do you believe it can provide some pressure, some relief from the pressure on highly indebted emerging economies with a large share of dollar-denominated debt? And has this downward pressure...
Dollar-denominated debt, that means countries that their money is created based on being insured by American dollars, as opposed to ye olden days when it was insured by the crown jewels or precious stones in the royal vault. I'm going to start her again. Where's she coming from?
Pierre, I wanted to ask you about the downward pressure on the dollar now.
On the dollar,
to what
exchange
extent
rates.
do you believe it can provide some pressure, some relief from the pressure on highly indebted emerging economies with a large share of dollar-denominated debt? And has this downward pressure on the dollar changed your outlook on all of those emerging economies that are still, under the impact of the high debt, as mentioned by the MD in previous meetings, where this high debt
she's saying
is really one of the impediments to growth. Thanks.
Impediments to growth.
Yeah, so
She's
we're
basically
seeing
asking
a weakening of the
now
dollar
that the dollar is getting
fairly
weaker,
broad-based
in other words, it's cheaper to
over
buy
the last
dollars.
few weeks, as I mentioned in my
How will it
opening remarks.
impact
Some of that
countries that
is coming from the weaker
can
growth
borrow
prospects in the
and
US.
buy
Some of it is
dollars
coming
for
from the
less?
increased uncertainty
to spend
it's
and
leading
create
to,
their
a
currency
reassessment of
in their
the global
countries
demand for
to make it
dollar
easier for
assets.
people to
When we step back, we also have to realize
borrow
we're coming
money,
from a position where
invest,
over the last few
grow,
years,
businesses
there's been
innovating,
tremendous capital
building more
inflows
machines,
into U.S.
improving
markets,
their
in
fields and
particular, risk markets.
Let's hear what the boss here has to
Something
say.
that, of course, my colleague Tobias Adrian will talk about in the GFSR press conference. So we are seeing some adjustment, some correction. The markets are handling it.
He's calling it a correction.
We don't see signs of stress, even in currency markets. Now, the interesting development
he's
is
saying
what does it mean for emerging
it
markets?
won't stay cheap
And
for
you're
long.
right to point out that in the past, when dollar would strengthen, that would not necessarily be a good news for emerging markets because they have
Whatever it's gonna do, it won't do it for
dollar-denominated
long.
debts. So that increases their liabilities and the pressure on them to service those debts, and that can lead to some tightening of financial conditions. So we are not seeing that right now.
Servicing
That
debt.
In the past, when dollar would strengthen, that would not necessarily be a good news for emerging markets because they have dollar-denominated debts. So
Right.
that increases their liabilities and the pressure on them to service those debts, and that can lead to some tightening of financial conditions. So we are not seeing that right now, and so that's a plus. The flip side of this is, of course, the
He's telling her
appreciation of some of
it's a
these
good thing on
emerging
the one
markets
hand.
currencies means that they are also losing a little bit on the competitiveness side. So there is maybe something that is a bit easier on the financial conditions, something that is not as easy on the trade side. Finally,
That if
this
they're-
is an
so he's
environment
saying
of
that-
enormous uncertainty,
Because
increased volatility.
if the
and
value
that,
of-
I think, is something that will dominate for
if the value of your currency goes up, that means your purchasing power, your ability to buy stuff from abroad goes up too. So he's saying if the domestic currencies, if other domestic currency, like not non-US ones, go up, then they might struggle when it comes to trade because yes, you can buy more stuff from abroad, but it's the other side of that is that exporting stuff to abroad is more difficult because your stuff just got more expensive. The stuff you're selling, not the stuff you're buying from abroad.
in many of the emerging markets. So when we're looking at our assessment, we are actually downgrading the emerging market economies for 2025 and 2026. Most of them, some of them may, as I mentioned, benefit.
And in conclusion, to wrap it up, he says, so overall, on net, emerging countries are kind of screwed because they're so dependent on trade.
But overall, as a group, they're downgraded.
And what he's probably not saying is that
they're also very plugged into the global supply chains.
There you go.
The uncertainty is leading to a pause in investment and activity, and they're going to suffer from the decline in demand for their products coming from the tariffs.
So he's saying, yeah, that they're so plugged into the global economy that the impact of the trade is going to really hurt them. Being hurt by the impact of the trade is going to negatively affect investment domestically, innovation. You know, the stuff that they were alluding to, saying earlier, it might be a plus. What he's not saying is that because a lot of those emerging countries have emerged from nothing because of this global trade structure. There is nothing there domestically, even in the most economically ideal situation, for the kind of growth that could happen under the ideal situation would happen. Like things like brain drain, where the biggest and the best entrepreneurs leave the country to go do business elsewhere, or the best students leave to go to other universities, to the best universities abroad, and after they finish studying at the universities abroad in the UK, US, or wherever, they're instantly recruited into internships in multinational corporations that are multinational corporations and monsters because they are part of this global trade, globalized economy, globalization machine, never to return to their homelands, and set to be on a 20-year, 30-year career path, probably with the same company. No, he's not saying all of that, but you can kind of see in the look of his face that it's, and they said it in their outlook for 2025. The outlook for emerging economies in 2025 is looking kind of grim, according to them. Let's carry on.
Okay, I'm going to go with the gentleman here with the glasses.
Thank you. Andrew from the Austrian Daily Standard. I just have one question. Could you elaborate a little bit on what will happen with trade flows in your models? I saw that in the basic assumption the exports from the US are breaking in quite heavily, but not that much from China. Why is this so? And do I understand right that this basic model does not yet integrate the additional hikes after basically April 9, so above 100% on import tariffs by the US? Thanks.
What?
So we are seeing
Exports from the US are breaking in quite heavily, but not that much from
Breaking?
China. Why is this so? And do I understand right that this basic model does not yet integrate the additional hikes after basically April 9, so above 100% on
he's questioning the
import tariffs
numbers.
by the US? Thanks.
He's questioning the numbers on the graphs.
So we are seeing a large impact.
The answer is because, like I said at the start, they're trying to peddle some kind of more optimistic view of what's going to happen and what the outlook looks like, because the uncertainty is whether things are going to go down or up is based on how we react to everything. And that's it. That is what economics is. Economics is just another way of saying mass psychology. And economic policymakers or chief economists, they are like mass psychiatrists in a way. But yeah, exactly like that. They don't have any what's that thing that doctors have to, Hippocratic oath. They don't take any kind of Hippocratic oath that says I will do no harm, I will only do good. Although I think compared to some psychiatrists, they are a lot. There is a vested interest to be ethical because they want to keep optimism up. They want to not always. He said earlier in the video about consumer confidence falling. Sometimes they want consumer confidence to fall sometimes, because if we're too confident and then we spend too much and prices go up too much, then you have hyperinflation, and they don't want that. No, they want to keep things within a bracket. That's a whole other lesson.
On global trade.
It's a 45-minute video, so I don't want to hold pause
and
too
that's
long.
going to be the case under any combination of tariffs where the effective tariff rates remains very elevated. And the reason why, when we looked at the different scenarios that I mentioned, whether it's a reference scenario or our April 9 scenario, which includes lower tariffs on many countries but sharply increased tariffs between the US and China, the overall impact on the global economy is not very different, because the effective tariff rate is, if anything, even higher under that pause. So global trade is going to be significantly affected. The particular configuration of trade, which bilateral trade flows are going to be affected versus others, that will depend on the final landscape in terms of tariffs. So
when the dust settles, because the bilateral trade means a trade agreement between two individual countries without factoring in any kind of other agreements they have with any other country. Just you, me, let's sit down and talk about how how big the walls we're gonna put up between us, if any walls at all, right? And he's saying that the tariffs that are being put up between China and the US, because they are two huge components to the global economy. Think of just how much American products the world consumes, right? And think about how many components of products China produces. Okay? So I think what he's saying here is, yeah, we can factor in the kind of changes to tariffs with other countries, but really it doesn't really matter, because the global effect of these walls between countries' products called tariffs on overall is affected mostly by what the US and China do with each other. Simple example, like if there's components of Chinese machines that are bought by companies, bought by cars in Germany, by car companies in Germany, and then sold to consumers in the US, as trucks to move products in the U.S. to the South America, if at the bottom of that chain, supply chains, and he's going to talk about it later, if at the bottom of those supply chains there is an increased price, or if the increase of price is at the top of the chain, it doesn't really matter if that truck is what's used by 85-90% of the people in the world. The only time that might change is after the dust settles, and then that there's these one-on-one agreements that might restructure how much of that 80% is 80% if it goes down to 70, 60, 50%. Does that make sense?
So we can anticipate that there will be much lower bilateral trade under either the reference scenario or the April 9 between the US and China. And that is weighing down on global trade growth. This is weighing down on global trade generally.
Okay, I'm going to turn here to the center. I'm going to go.
I think I missed
first
something
row.
there, but let's move on.
I'm going to go with the lady with the yellow bottle.
Because I was talking about bilateral trades between the U.S. and other countries in China and other countries. He's talking about bilateral trade agreements between the two of them.
You've downgraded the UK's
which might be like, oh, okay, well, let's change tariffs on certain products from you guys.
Tariff barriers to more domestic
that might
issues
affect,
like cost of living pressures.
Like I
Out
said,
of those,
manufacturing.
global challenges versus the domestic challenges. Which
Let's
one
cut
is
Germany
weighing more
out.
heavily on the UK's growth forecasts?
Okay, we're going to open the round of UK questions. So if you have questions on the UK, raise your hand and I will pass the mic to you. I see Chu there. Yep.
Hi, Sue Chan from The Telegraph. In a world where everyone is warning about the impact of tariffs on US inflation and how much it will raise US prices, why do you have the UK with the highest inflation rate in the G7 this year? And do you believe tariffs will be inflationary or disinflationary for the UK?
Okay, Joe here in the first row.
Hey, Joe.
Yeah, thank you very
that.
much. So, Joel Hills from ITV News. Obviously, it's impacting, the tariffs are impacting the UK, they're impacting most countries. I just wonder this, President Trump did say that there would be some disruption. He suggested it would be sort of temporary. Is it possible
He's getting a fanboy
that
now.
President Trump is actually a genius? That he knows something you do not?
And I think we have a last question on the UK, and this is going to be the last question on the UK there on the back of the room.
Yeah,
He's
Alex
happy about
Brummer from
something.
the Daily Mail. The UK inflation forecast is, much higher than we expected it to be, 0.7% higher. Is that going to impact on lowering interest rates?
That doesn't
in the
sound like a
UK?
lot, but when their
And does that
target is
affect the growth
2%,
rate, which seems
it's
to be
a lot.
rather optimistic compared with some of the other European countries.
Okay, we are going to be done with the UK questions, and then we will move along. So, Pierre-Olivier?
So we have,
Thank you.
is
So
the
many questions.
inflation
Let
rate
me address them
predicted
as
higher
best I
than the
can.
rest of Europe?
So first on
Is
the
Donald
revision
Trump a
for growth
genius?
in
And what was the
UK
other question?
And inflation. So the tariffs are playing a role, as they are in most countries, and uncertainty is also playing a role, as it is in all countries. And it's weighing down on growth in the UK. But there are some UK-specific factors, and I would say that in terms of the 0.5 percentage point downward revision that we're seeing for the UK, the domestic factors are probably the biggest ones. And in particular, there is a lower carryover from weaker growth in the second half of last year. There is also some tightening of financial conditions as interest rates have risen, longer-term interest rates. On inflation,
That means people's mortgages.
the revision in inflation in the UK is coming from, again, from domestic factors, and in particular, some change in regulated energy prices. So that's expected to be temporary, but it's also very UK-specific. The effect of the tariffs on countries like the UK, like it is on the EU or China, is like a negative demand shock. It's weakening activity, but it's also lowering price pressures, not increasing them. Now,
How's that? How is it
what is
lowering?
the impact of the tariffs in the medium and long term.
That is a very theoretical thing that he's saying. What he's saying is, yeah, we know that in the UK your energy bill is getting higher and higher and higher. We know that the price of your mortgage, the loan you bought your house with, right, that's going up and up and up and up. But yeah, these tariffs they might actually help you because it's a demand shock. Demand shock means that it will decrease demand. So the theory goes, when demand is lower, prices drop, right? But why do they drop when demand goes down? Because supply goes down. For supply to go down, that means that there are businesses that will go out of business. Those businesses have energy bills to pay, and they have mortgages to pay as well. So hold on to your hats, Britain. And the reason why it's going to be a demand shock is because Britain doesn't produce anything, okay? The British economy is a big, powerful economy, but like 60% of its economy is based on exporting services, not products or producing products. It's most of the British economy is built on exporting services. And of those 60% services, 70% of those are financial services. That means bankers in the city of London on the phone sending emails, okay? Not sheep farmers exporting mutton chops.
And not just what's going to happen this year or next, but what's going to happen longer term.
Or the businesses that are going to have to
That it's
suffer
gonna be
and
negative.
shut
We
down.
have a box in our report that looks at the long-term impact of the tariffs if they're maintained, and it is negative for all regions, just like the short-term impact. So we're seeing a negative impact.
So he's saying,
in the
don't
short
worry,
term,
Britain,
in the medium term,
it's going
in
to
the long term.
suck for
Again,
everybody in Europe.
There are nuances. Some countries might benefit depending on the particular configuration of tariffs.
But some countries might
but the broad
benefit
picture
from
is
some
negative for,
diversion
for the
depending
outlook.
on their structure.
Now, and I will end with that, our forecast for
Just a
2025
sprinkle, just a drizzle,
is,
drizzle in some
slightly
optimism.
higher
Maybe
than,
offset some of that
OBR's
uncertainty.
forecast. Some of this has to do with
Which countries?
Some of the underlying monetary
I
policy
don't know. Who
assumptions.
cares? Some countries,
For,
maybe.
The UK,
Okay.
the bank, our assumptions for this year is that there are going to be
Maybe Greece.
4 cuts
Hey.
through the year. 1 cut already happened. We
And that's
expect
because
more.
it can't get any worse than it already
Thank you,
is.
Pierre-Olivier.
Thank
I'm
you.
not gonna
And
forget
Ukraine,
about the
right?
people that are on
Thank you,
WebEx,
Olivier.
And I'm going to pass a question there. I see Anton from TASS. Please go ahead.
Good morning. Thank you for doing this. Anton Chudakov, the TASS News Agency. Given the projected slowdown of Russia's GDP growth from 4.1 in 2024 to 1.5 in 2025, what
From
are
4
the primary
to
factors
1?
driving this sharp decline, and how sustainable is Russia's growth model going
Is Russia's
forward?
growth model.
Thank you.
When was it 4%? When was it 4%?
In 2024 to 1.5
2024.
in 2025. What are the primary factors
So in 1 year it
driving
went
this
from 4%
sharp
to
decline,
1.
and how sustainable is Russia's growth model going forward? Thank you.
How sustainable is Russia's growth model going forward?
Petya, would you like to?
This I want to hear.
Sure. So we are indeed expecting a slowdown in growth to 1.5 this year. And this, to a large extent, is kind of the natural slowing of the economy after growing quite robustly in previous years. And
Natural?
also as a result of policy tightening that we've seen both on the fiscal as well as on
Hold on a
the-
second. There's nothing natural about spiking up to 4% in 1 year and then dropping down to 1% the next year, especially not for the Russian economy, which is, I think, historically not really characterized by such sharp ups and downs. Isn't that why they call it the sleepy bear or whatever? Sounds kind of bullish to me.
Monetary policy side. It is also due to the lower oil prices that have come about as a result
Sharper monetary
of the,
policy.
as a response.
That means, and I don't know if this is a fact, raising interest rates suddenly and sharply.
to the to the
And
round
oil.
of tariffs, as well as the uncertainty about global growth. So all these factors behind
Uncertainty about
that
global growth.
lower growth number.
No mention
although I
about
should point out that
war.
it is actually
No
a
mention
slight
about
upward revision
the
relative
number
to what we
of
had
the most
back
capable
in
human
January.
beings in the
And,
country,
the reason for
men
that
between
is
the
that,
age of 20
again, we
and
actually had
45
seen
being
upward
slaughtered on
surprises
battlefields.
in
No mention of that.
2024, which kind of
Yeah, that has
carried
nothing to
into,
do with it. Nah, let's
into
just
2025.
let's talk
When
about
it
interest
comes
rates.
to the medium-term growth outlook, we
And
do
oil.
expect that to be relatively weak. We have penciled in growth number of about 1.2, which is down from 1.7, which is what we had before the start of the war.
Okay. Let's continue.
Before the start of the war, and she backs right out
I'm
of
gonna
it.
go
As soon as she
again
says the
in
word,
center,
did you
and
see
then
her
I'm gonna
just
go to that
implode?
side. The lady with the glasses there.
So the war had nothing to do with it, or it had everything to do with it? We're just not
Hi,
commenting.
Maria Rosa
Okay.
Villalobos from El Comercio, Peru. In Latin America, we received almost every country 10%.
Buenas
So I want to know
noches.
about the impact
Buenos
of the
dias.
tariffs in
Sorry,
Latin
it's
America,
American time.
and if the impact is going to be limited versus other regions, and when we are going to start to feel in this impact. Thank you.
And before we answer the question, are there any questions on Mexico, Brazil, Argentina?
So now the South Americans piping up. Let's.
And when?
What was the question?
In Latin America, we received almost every country 10%. So I want to know about the impact of the tariffs
Okay.
in Latin America.
So
go ahead.
10% South America.
Hello, Patricia
Kind
Valli
of
from El Cronista
gentle compared to other
newspaper.
countries. So
You
I think her question is
kept the 5.5 growth
on relativity.
projection that was
And what everyone's kind of asking
decided in the
them
latest
to
program that Argentina signed.
take
with
a
the
crystal
IMF.
ball out and predict
I would
how
like
the
to
dust is
know,
going to settle. But that
why,
is not how this
you're not
works.
seeing, so
They
much
know that on the
impact
panel.
yet, about,
And they know that the
of
only
this general
genie they can let out of a bottle is the genie of optimism.
Okay.
The genie
We
of
can go ahead first with
curbing
the Latin America
uncertainty,
overview,
giving
and
some
then we
sort
can
of
go to Argentina.
confidence
I'll
in the
just say
banks.
something briefly and then ask my colleague Petia to come in. So for Latin
So that
America,
monetary policy
as a
can be more
whole,
effective,
we're
so that it
seeing
can work.
activity that is largely driven by consumption on the back of resilient labor markets, while investment remains somewhat sluggish. And the slowdown in our projection reflects the impact of tariffs and the global growth slowdown, of course, which is also affecting countries in the region, policy uncertainty, and the withdrawal of fiscal stimulus and in some countries, monetary policy tightening.
Yeah, I don't have a lot to add, just to say that the disinflation process has also slowed a bit, and this
Disinflation is not deflation, it's not inflation, it's when the year-on-year increase in prices is getting smaller and smaller. So this year we went up 3% from last year, and then it's going to go 2% from the year before, 1%, 0.5%, 0.3, 0.2, and then once it starts going negative, then you have deflation.
is also
Deflation means prices are going down. Prices are not going down yet. If an economy, if there's a recession, they should be. So there's this weird thing about cause and effect. Like they might be saying, "Oh yeah, well according to historically, right, we call things recession when output is going down, growth, which means growth is going down, and the prices are going down, and people are becoming unemployed, and everything's going down, 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 and then they come back up again. But if one thing's going down, the other thing's not going down with it, they're like, well, we can't call it a recession because historically, recessions, when things really suck, is when all these things are going down. And that's because that's what happened historically, that's what we put into textbooks, and that's what then people have to go teach, including myself, and then what people learn, and then they go off and get jobs as economists, and then they sit on panels and say that same stuff again and again and again. But here's the thing, what's going on today has not really ever happened before. And in markets like the stock market, which is it's free of these kind of theories. But on the one hand, and on the other hand, it's just based on individuals' theory, also known as speculation. as soon as the tariffs hit, we saw historic lows in Asian markets and historic highs in American markets. And everybody was like, "Oh, what does that mean? What does that mean?" For me, all that confirms is that what's happening right now is first time in history this kind of stuff is happening. And what that means, I'm going to argue, is that a lot of the economic theories that underpin the way we try to regulate these people and people like them, try to regulate and control things, is kind of not irrelevant, but a lot less relevant.
Makes the policy trade-offs a bit more complicated, with growth slowing down, and at the same time, having still challenges on the inflation side.
Okay, so we're gonna move on. I'm gonna ask the gentleman in the first row there because. Oh, sorry. I forget about Argentina. Please go ahead.
We cannot forget about Argentina.
No.
So the growth forecast for this year, you're right. We still have the upgrade of 0.5, and this is related to just the positive surprises that we had seen. In spite of a very strong fiscal adjustment, the recovery in confidence, I think, has definitely played a role in
China has a big appetite for meat,
driving us to have this forecast. That said, there are a number of risks related to tighter financial conditions, commodity prices, and a lot of others.
So if they can't buy US, they'll buy Argentina.
Most other countries.
Delish.
So now
I don't know if that's true. Just theories. Maybe that's what they're not saying.
Thank you. My name is Francis Into. I write for the Ghanaian News Agency. In the October 2024 outlook, you saw a stable but slow growth for Africa. What's new now, and what can initiatives like the African Continental Free Trade Area do for African economies amidst these trade tensions?
And before we answer, I think, Cami, you can.
The big question. Look at them just staring at their notes.
Hi, good morning. Kemi Oshikoya with the Africa Bazaar magazine. One of the things that you mentioned in your report,
good question, Francis,
is the demographic shift and the rise in the silver economic. Africa, on the other hand, has the reverse of that. So what is your recommendation in the short and medium term on how to deal with some of these challenges pertaining to tariff, monetary policy, and currency exchange? Thank you.
Okay.
Thank you. So I'll just say one word about the outlook in sub-Saharan Africa, and then I will ask my colleague Denise to come in
and rescue me,
color, and answer also the question on the demographic trends. So regional growth in sub-Saharan Africa improved significantly last year to 4%, and it will ease in 2025. And this is in line with a softer global outlook. And so we are seeing the same forces at play in the region as we are seeing more globally, and a downturn in the downward revision in our projection that is of the similar magnitude at about 0.4 percentage point. Denise?
You're just as screwed as everybody else.
Question. So on the demographic shifts, our chapter 2 basically points out that countries' age structures are evolving at different rates. As you pointed out as well, we have most Western economies, some Asian economies that are aging fast and in a healthy way, some of them. And then we have many sub-Saharan African countries that have a very young population. And what the chapter shows is actually there are important medium-term consequences of that, both for growth as well as external balances of countries. In Africa's case, basically what we would see is a demographic dividend coming from having a young population. And the question then becomes how best to leverage that, how best to use that and channel.
Democratic dividends from a younger population means that there's a lot of young people in Africa willing to work really, really hard for close to nothing. And the question is, how do we turn that into a force of economic growth compared to other countries that have like declining populations or negative growth, like shrinking populations. I think Japan is still one of them. Greece is another one of them. In Europe, right in Europe.
Into growth. And the answer there, first and foremost, depends on the structural reforms, the investment that's necessary on healthcare, on education,
structural reforms,
on human capital more generally.
Yeah. Structural reforms does not just mean building roads and highways. It means, like she mentioned, building schools, building hospitals, healthcare, the social structure, social infrastructure, not like just physical infrastructure.
And also international cooperation, because our chapter 3 looks at more carefully onto migration flows. And again, there we see that migration policy shifts in destination countries has spillovers for other countries, and this is especially true for emerging market economies and lower income economies. So again, international cooperation there, making sure that the growth dividends are utilized in the best way is what we delve into in the chapter.
Okay, I'm going to go to the gentleman.
Okay, so they have a plan for young people in Africa to...
Raise your hand. Yeah, you. No, I'm going back. Then I'll go...
Build sustainable lives for themselves in Africa.
Okay, thank you. Reporter from China Daily.
Africa's kind of the IMF's...
Yeah, question about China's growth. In your World Economic Outlook, you say China's growth forecast has been cut to 4% for this year, which is a 0.6 percentage
its way up
drop
to European countries
from
like
earlier
Greece.
projection. But China's National Bureau of Statistics a couple of days ago says predicted China's growth, GDP growth in the first quarter was 5.4%. So my question is, how do you see the disparity in the forecast? Is China more optimistic than you are? Thank you.
Good question.
Should I go?
Yeah, go.
Thank you. So yes, we
and
are
follow up with why
revising our growth projections for China down by 0.6 percentage point, as you've noted. I should flag that this number does not incorporate the latest release for Q1 that came after we close our round of projections. So this is not reflected there, and we will have to see how it affects our projections when we have our next round of WEO updates. But let me give you a little bit of perspective on
the confusion of
rationale
cause and
behind our
effect
revision for China.
Well, you revised yours,
tariff,
so how optimistic you are
especially since
affects
China is
how
one of
we
the
are
countries
going to
that is
predict
facing the most elevated
everyone
tariffs
else is going
right
to be
now, is going to
'cause you're
have
China.
a very significant impact in our projections on the Chinese economy. In fact, when we do a decomposition, which I showed during my opening remarks, the impact of the tariffs on the Chinese economy would be a negative 1.3 percentage point on revision on growth. So why do we only have 0.6? Well, because there are other factors that are helping to support Chinese growth in 2025 and 2026, one of which is quite important, is the fiscal support that's been announced since the beginning of the year. And that is
fiscal support, remember?
Something of the
taxing, taking with one hand,
point.
expenditure,
so the,
spending it
impact
with the other,
of the current trade tensions
maybe
is very
infrastructure.
significant. It's partly offset. We expect it to remain quite significant also in 2026, when we have also a downward revision by about 0.5 percentage point. The other side of this, where we're seeing the impact of the tariffs, is on inflation, which is revised down. Our headline inflation projection for 2025 is actually at 0. So it's down from 0.8% to 0. So China is facing stronger deflationary forces as a result of these trade tensions.
Okay, I'm going to move
and remember, once inflation goes from disinflation 0 to negative, then you have deflation. Are they going to be growing at that point, or will the economy be shrinking at that point, in which case then it will be the textbook definition for a recession?
Beside the gentleman with the glasses here.
But there's a lot of those in the room.
Mohammed Badawi, the New Arab newspaper based in Qatar. What impact the oil prices will have in exporting and importing countries in the Middle East? Thank you.
Go ahead.
So we have seen oil prices declining since our last projections, and the decline in oil prices in our interpretation is coming mostly from weaker global demand. So it's the weakening of global activity that is driving the decline in prices. There's been some...
as opposed to energy demand shifting to more sustainable, renewable sources.
Increase in supply coming from OPEC plus countries, but broadly speaking, the decline is mostly coming from weaker demand. So that is going to play out in ways you sort of would expect. The commodity exporters are going to face lower export revenues from the decline in oil prices. That's going
Commodities, those are like raw materials, things at the bottom of the chain, like oil or rice or corn or metals, iron ore, cotton,
going to weigh on their
coffee, sugar,
fiscal outlook, on their growth. For those countries that are oil importers, it's going to lower inflation pressures, because that lower oil prices is going to feed into lower headline inflation. It's going to also provide some modest support to economic activity there. Denise, anything to add on oil prices or Petya?
No, I don't.
Okay.
Okay, so we're going to move to the center. I'm going to get the gentleman with the white shirt there.
Bilateral trade.
Jeremy Warner, Daily Telegraph. I'm not going to ask another question about the UK. You'll be pleased to know. Over the last week, we've seen
don't let the accent fool you.
attacks by the White House on the independence of the Federal Reserve. How destabilizing do you think this might be for financial markets?
So,
I tuned out for a second. Federal Reserve.
Do you think this might be for financial? Another question about the UK.
That's the US Central Bank.
Over the last week, we've seen a number of attacks by the White House on the independence of the Federal Reserve.
Oh yeah, he called them idiots.
How destabilizing do you think this might be for financial markets?
So the question really is, now that Donald Trump is calling the central bank, the Federal Reserve, the American bank of American banks, that does not work for him and he does not work for them. Now that he's called them idiots, how's that going to affect things?
Central banks are facing a delicate moment. As I've explained, in many countries, the impact of the tariff is going to...
Yeah, a very delicate moment. No one's asked or mentioned cryptocurrency yet. It's like, are you going to be kicked out of the room if they do?
Be to increase recessionary forces, and is going to lower price pressures. And that will help central banks cut interest rates faster and provide some support to their economy. But in other countries, and in our projections, the US is in that category, the tariffs are going to increase price pressures. Price pressures in the US are increasing for other reasons as well. Service prices have been inflation of service prices has been quite strong. And that is something that we're seeing already, but the tariffs are likely to increase price pressures. We're projecting inflation to remain at 3% in the US this year, same level as last year, headline inflation. So in that context,
prices are going to go up.
Also think about where we're coming from. We're coming from a period of very elevated inflation. We're just coming off the cost of living crisis, a surge in inflation rates to double digits that we haven't seen in more than a generation. So the critical thing is to make sure that inflation expectations remain anchored, that everyone remains convinced that central banks will do what is necessary to bring inflation back to central bank targets in an orderly manner. And central banks have instruments to do this. They have their interest rate instruments, they have various instruments of monetary policy. But one critical aspect of what they do is coming from their credibility. So central banks need to remain credible. And part of that credibility is built upon
even winked
their
me
central
other
bank
things.
independence. And so from that perspective, it's very important.
And the reason why he winked is because a few of those other monetary policies, they had to invent them, make them up in recent years in his lifetime because interest rates weren't working anymore.
Preserve that.
Okay, we're going to have time for 2 questions. One of them is going back to WebEx. I see where.
Like quantitative easing, which they invented during the credit crunch. That almost brought the monetary system to collapse. It definitely brought it to its knees.
Yes, come in.
Yes, we are good with E-Thai Media Group, and I have a question. You mentioned that the global economic system is being reset, and I'm not sure if one of the early signs in the financial markets, as we see that the market's moving from American exceptionalism to the sort of sell the U.S. narrative. So could you add
sell the U.S. narrative
for the financial market and the world economy as a whole?
Yeah, well, we've seen some volatility in the markets, of course, whenever there is going to be potentially significant change in the economic structure of the global economy. I think we're bound to see some reassessment, and investors are going to try to figure out what's happening, and that's going to inject volatility, and we're seeing some of that. The good
and
news
that is very profitable for some
people. A lot
people.
of that volatility that we've seen in the last few weeks has not led to
devastating
significant market dislocations or market stress to levels that would, for instance, have necessitated interventions by central banks around the world.
Or you guys.
So whether you're looking at equity markets, whether you're looking at bond markets, whether you're looking at currency markets, what we're seeing is a reassessment of the world we are in now. And that
what we're seeing is
a reassessment
basic
of
economic principles
of risk assets
at work, working. Trump's not a genius.
But that is happening in an orderly manner. So
I've had high school students that if they were president, they probably would have done exactly what he's doing.
That remains
textbook.
Resilient, but of course we're watching carefully, and there's been some tightening of financial conditions. And that's something to be looking out for. We want to make sure that it doesn't get to a level where the stress in the financial system would become too extreme.
Okay. The lady here in the first row has been waiting patiently. Please go ahead.
The stress on the financial system, like the credit crunch, the monetary, might not happen, right? They've really fixed, you know, that whole situation was a first time in history situation where they had to come up with new ways of regulating the monetary system. This current situation with the tariffs and everything, taxes, is more of a fiscal, is kind of like the fiscal equivalent of what happened during the credit crunch on the monetary side.
Marlene Shong with Xinhua News Agency. I wanted to ask about the trading tensions impact on low-income countries. You mentioned there are like downgrading.
And what everything that's been happening over the past few weeks says, and this what I'm watching right now, and what I want to hear, what will probably roll out when they have their regional press conferences as well, is that even these guys, even the bankers of the bankers, like the deep monetary invested economists, are kind of like, yeah, could swing either way. Things could swing either way. I think that's what he was just saying, is we're not really going to do anything unless we see like a systemic failure on the horizon, and really all we see on the horizon is some pretty textbook things. Maybe a recession, if we want to draw the line here, but like they're playing with fractions of percentages. That's hardly cataclysmic, globally speaking. And it has to be globally speaking for it to be systemic, and it won't be. It really, we're talking about trade. There's going to be some big winners and some big losers, which is why all their graphs on net, I'm predicting, on net globally, which is what they're talking about, the global, because that's what they're concerned about, globalization. The IMF is big on that on their radars for globalization, overall, things will be kind of just a little bit bumpy and a little bit rocky, nothing too extreme. But if you zero in on some countries, there's going to be some countries that are going to really, really suffer, and some that are really, really going to win. Watch out, Africa. It's a big continent, a lot of countries.
Emerging markets, but how about like those small countries who have lower income as a group? Have you assessed the particular impact on them in this ongoing trade tension? Thank you.
Well, thanks. So for low-income countries as a group, we are also seeing a downgrade, which we report in our report of 0.4 percentage points. We're expecting growth of 4.2% in 2025. So the 0.4 is very similar to what we're seeing at the aggregate level, 0.5. So from that perspective, it looks quite the same. However, there are also a lot of differences across countries. And when we look more carefully, you might see some vulnerable countries, especially in sub-Saharan Africa,
here we go,
but elsewhere as well, who could face very challenging conditions as a result of the tariffs in an environment in which many of the countries, low-income countries, have been facing a funding squeeze for a number of years now. Private capital flows to this region have been drying up or have been coming on very expensive terms. We're seeing a drying up also of some official aid flows. So some of these countries have very limited fiscal space.
Money.
They're in a situation where
no money.
The situation could become more challenging. Now, on the flip
it's
side,
like playing Monopoly and you've run out of money.
Prices coming down for many commodities.
What do you do?
Help some of them. The commodity
you either step away from the table or what?
Will hurt the ones who are commodity exporters, and there are a number of countries in
who's going to buy
low-income
sub-Saharan Africa
that are commodity exporters. So that's adding some additional pressure on them.
Maybe this trade war is going to turn into a turf war between the U.S. and China.
One last question. So I'm going to go with the gentleman on the white shirt there. He's been waiting patiently too. And don't get frustrated. There's going to be many opportunities for you to ask questions.
Thank you, Jose. Awan Luca from IFA. I had a quick question about Spain, because that's the only country amongst advanced economy where you have an upward revision. It's going to be way better than the Eurozone and even better than other advanced economies. What are the underlying reasons for that? And you formally talked mostly about tourism, but is there any other thing that might be pointed out? Thank you.
So yes, indeed, Spain is doing better than its peers. Petya, would you like to talk about it?
Sure. Indeed, we are actually having an upgrade for Spain this year, which is a rare occurrence in the many downgrades that we've had for other countries. This is partly because the Spanish economy just had such strong momentum in 2024 coming into 2025, and part of that was due to the very strong services exports as well as the very strong labor accumulation, part of that related to immigration. But all of that being said, Spain is still being affected.
British people retiring to Malaga
by the tariffs and
taking their work from home businesses with them. Digital nomads. That's what it is.
Underlying strength is kind of having a bigger impact in the near term. But then again,
not just tourists, people that are permanently going for the good weather.
Kind of slowing of growth to about 1.8.
And more people habla Espanol than they do Greek.
I want to thank you, everyone, on behalf of Pierre-Olivier, Petya, Denise, the research department,
muchas gracias.
The communications department. Some reminders. Next press briefing is going to happen.
That's a win for the IMF and globalization.
Stability report. Please stay tuned. Tomorrow you have the fiscal monitor, and then later
maybe it's going to be the blueprint for the future.
Director's press briefing, and also all the regional press briefings that we've been talking about.
With territory wars in Africa.
Thank you very much for your time. If you have
for non-services, because the service is not just financial services, it's anything you could produce from your laptop in your home. Digital nomads. Okay, that is a wrap on this live stream. Subscribe if you want notifications for the next one. There's going to be more IMF stuff coming up this week, and I'm going to watch it and talk into my camera and microphone and get around to doing an edit to cut out all the ums and ahs and other stupid things. who knows, maybe if at the end of the week there's becomes some kind of narrative, I might put it all together into something more tidy.